Got the management of JK Tyre is now joining us. Nigel.
Okay, all right. Well, let's get straight to that then. JK Tyre, they reported a weak set of numbers. Higher input costs and supply chain issues weighed on the earnings. We had the gross margins as well that did see a decline. To help us out with the outlook from here on, we have with us Mr. Anuj Kathuria, the President, India at JK Tyres Industries. Hi, sir. Good morning and good to see you. And thanks a lot for speaking to us here on CNBC-TV18. Let's address both those 2 points. The raw material basket cost has moved up. I think you had indicated as well it could move up by 5 to around 6%. So that was in Q2. For Q3, will it be flattish? Will it be lower? Could you give us clarity on that? Point number one. Point number two is there are supply chain issues which you have faced. Are they now getting ironed out?
Yeah, as far as the raw material basket is concerned, in Q2, we saw an upswing, mainly led by the natural rubber and the synthetic rubber. The good part is that now we have seen that it has come down a little, but this also has to be watched very carefully. We are doing that, and we expect that in Q3, there would be some impact further because there is a carryover from Q2. But going forward, maybe December onwards, things should start softening, and the overall raw material basket prices should be in control. On the supply chain side, yes, there were some challenges in the earlier part of Q2. But September onwards, we have seen that the situation is much better. The availability of the vessels, the containers, and also, whatever we export into the Americas, for that, things are much better. And going forward, we expect that the situation will be similar, and there wouldn't be much of a challenge. In fact, if you take our Q2 numbers, in exports also we have been able to do quite well. And that has actually been quite helpful in offsetting some of the impact that was there because of the sluggish demand, especially from the OEMs.
Okay, so that's good news. If, RM issues will get sorted out by the end of the third quarter and supply side issues as well are getting sorted out, that's good news. What about price hikes? Could you quantify what are the price hikes you have taken so far in Q3 in comparison to Q2? And on a blended basis, how much higher will prices be?
So we have been continuously taking price hikes. Right from April, we started. So we have been able to, roughly, if I were to quantify it, say whatever has been the raw material impact for the year as on date, we have been able to take price hikes which are equivalent to almost 50%. But yeah, there it leaves the other part. But there again, we have taken another hike in the beginning of November. And going forward, based on the market dynamics, we will be looking at further hikes if they are required. But on the other side, we are also watching the raw material basket, and we will have to balance this out very carefully. And actually, that is how we play it out.
What does it mean in terms of margins? I'm looking at your India business, which is bulk of your total revenues. Out there, the profitability has got hit. So give and take everything, raw material basket cooling off, you have taken price hikes, supply chain issues as well getting sorted out. What does it mean on margins? Last quarter, it was in that vicinity of around 11.5%. How much better will it be for the second half of this year, Q3 and Q4?
So if you look at the EBITDA margins in Q2, we reported our EBITDA margin of 12.2%. Yeah, it is down as compared to the corresponding quarter. But if you take the total raw material impact, we have been able to kind of negate some of the, we have been able to sustain the margin mainly because of our efforts on product premiumization, better mix, operational efficiencies, and we also had a strategic buildup of the raw material when it was going up. So all this has been able to help us to sustain the margins in Q2. Going forward, we expect the margins to be better.
But how much better, sir? How much better? According to your calculations, around 12.2% for the past quarter. So can we expect it to improve, say, by 100 basis points in Q3? And by Q4, in comparison to what you have done in Q2, should it be another 200, 250 basis points better?
See, generally, we are looking at a range of 13 to 15%. That is what is the industry average. And we would definitely like to get back into that range.
So 13 to 15% is what you'd like to get back at on a full year basis. That's helpful, sir. It kind of tells us at least your aspiration level where you want to be. Similarly, as there's recovery in the second half, on a top line level, what kind of growth can we expect? Full year.
Even if you were to look at our quarter two results, while the overall top line it was muted, but in the replacement market we saw a positive sentiment, especially in the PCR segment. We expect that the momentum in the replacement market will continue, and we should expect even in the commercial vehicle segment the demand to be much better. Quarter four is generally a very good quarter because both OEM demand as well as the replacement market demand is robust. So overall, I think so. H2 definitely will be better than H1. Replacement market, we expect that we will be able to have a high single-digit growth in H2. For OEMs, we will have to wait and watch because there is this element which is there especially in the CV segment, where the demand is still kind of not picking up. But we expect that once the infrastructure spends, which kind of got deferred because of the elections and also because of the delayed monsoon, extended monsoon. So with that now behind us, we expect that in H2, on the back of the infra spends, also on the passenger car side, the festive season has brought in a lot of cheer. So with the pipeline stocks getting cleared to a certain extent, we expect that overall in H2, the demand both from the replacement market as well as the OEMs should be very positive.
Mr. Kathuria, we leave it there, sir. Good luck. Thank you very much for joining us, and hope to speak with you soon again.
Thank you.
We'll take